What's going on, guys? Hope you are all doing very, very well in this serious time, COVID-19. Seeing some green shoots at the moment, which is really nice. So hopefully we sort of come out of this pretty soon, and who knows what sort of impact that's going to have on the market. And I think people are already, starting to get excited again. I mean, there's been really no, media and stuff have tried to negatively report their property market, but realistically, with loan mortgage repayment and JobKeeper, JobSeeker, and all that sort of stuff, it's kept the property market pretty much afloat or stopped transacting pretty much. And so there's no real massive falls or highs or anything like that. So hopefully, as we start to come out of this, we even start to see a bit of demand and a bit of increased motivation from buyers. And I know there's not a lot of stock on the market at the moment, so supply is pretty dry, which means not a lot of good assets are on the market as well. And if they are, they're very rare, and so there's already demand for them instantly, because there's people out there who want to take advantage of this sort of opportunity, and they're obviously looking for those types of properties, and they'll probably get there. So yeah, very interesting times, but I hope you are all doing well. I think Victoria is now being coming out of stage 3, going to stage 1 of unlockdown tomorrow, which is Tuesday, and I think you get like 5 people over at your house or something like that. So yeah, starting to look good, starting to look healthy. Hopefully the economy picks back up pretty quickly, and we surcharge it out of this, and we've kept strong, and people's jobs come back into play. I think it's going to take a little while for consumer confidence to come completely back again. Probably going to not see unemployment come down to levels that they were for a little while. I think it's up to nearly or supposedly the actual value is around 10 to 11% at the moment. So, the RBA said they're not going to increase interest rates until that's below 4% again, which could take a little while to see. So probably going to be a long backlash, but we'll see what happens. So anyway, it is the Corelogics May release time to review. So the report came out a little while ago. I've just been super busy. We've been moving house and trying to sort out Airbnbs and all that sort of stuff. So a little bit slower this month, but let's delve into the data and see what they got to show us. So May monthly chart pack, same as usual, nothing too crazy there. Same as usual things here. I would say it every video, but if you want to really know what these means, go back to video 1 and I'll explain these into more depth. But essentially, it's pretty straightforward. There's nothing there that's too confusing. We're still a $7.2 trillion industry with $1.83 trillion of outstanding mortgage debt. So pretty low LVR there nationally. Growth in national dwelling values slipped to 2.1% in the last 3 months to April, down from the recent peak of 4% in December 2019 quarter. So yeah, we are starting to see the graph demonstrate now some of those drops in prices. And as I said in the previous couple of videos, because this data is so lagged all the time, it's hard to really see what is technically happening. But yeah, essentially this is what is happening. We're seeing a lower downturn in the market, and we're starting to see this reflect in the data now. So doesn't look too significantly lower than we possibly can, go below that sort of 0% line there. But yeah, we're definitely on the way, and if we get there, I'm not sure. As I said, data's lagged, so we don't really know how bad this impact is visually until we get there. So anyway, but quarterly change, everything's still looking pretty strong. Sydney, Melbourne reporting high numbers. The only thing is a regional Northern Territory showing negative figures there. So not to massively change on the quarterly impact just yet, but we'll see how the sort of next quarter changes. I think it's going to be a more impactful result there. Annual growth rates understate the recent slowdown in the momentum, but point to an improving market before the onset of COVID-19. Yep, so again, hard to see because of the data lag, but yeah, as they say, showing a bit of momentum pre-COVID-19, and hopefully we start to see that momentum pick back up again once we come out of this. Looking at the monthly change in different value tiers of the market, it is clear that high end of Melbourne market has begun leading the downturn. Yep, so as I talk about quite frequently, as we see here, this sort of 75th percent quartile are the stronger sort of dwellings, and they're priced the highest, which just means they're, income ratios compared to the value of the property prices are really, really high. So we're paying more for these types of properties. They're the sort of $2, $3, $4 million properties, very high end. And this is what we see fluctuate quite dramatically because they are valued so high. And when a piece of property is valued so significantly high, it's a lot of it is demand driven. And when demand gets ripped out of the market, that demand obviously shrinks and we see these prices go. And when we're in a pandemic such as we're seeing today, you know, these are tough times for some people and in all different industries and all different games. So it's quite hard for people who either rent or own these types of properties who have massive mortgages. You know, if their incomes can be completely ripped out, now they're on, say, job seeker or job keeper and they're getting paid $1,500 a fortnight or whatever it may be, you know, that's not going to pay for a mortgage of a $3 million house. So that's why we see these sort of higher end properties lead the charge in the downturn because they're so overvalued in comparison, and they're, by all means, they're generally worth it. You know, they've got beach views or city views or, you know, whatever it may be, whatever makes them so desirable that increases the demand. But essentially that's why, you know, we see that sort of top end start to tumble down and then the rest of these lower ends start to follow, and even that sort of bottom end, that 25th percent quartile, sort of even out, because if you think of you know, the job keeper payment in relative terms to what those property values might be worth, might be like $300,000, $400,000, $500,000. You know, a mortgage repayment at this point in time on an interest only loan, you know, is only you know, $1,200, $1,300, $1,400. So it's still achievable, but you just got to be tight with your money, and that's why we sort of see that it take more time for the lower end of the market to follow this downturn. Although it does happen. Each of the capital city markets were well into an upswing before the onset of COVID-19, with the exception of Hobart, which is starting to lose momentum after the long upswing. So yeah, still so hard to see there. There's no real, you can just see like a tipping point off there with Melbourne, you know, just here, but really it's so lagged, you can't even really see what's going on with the market at the moment, you know, and there's a lot of people out there who will say, oh, Corelogics always, you know, presenting this data in a way that we can't really see how it's impacting the market because it's going to impact consumer confidence and all that sort of stuff, which is perfectly fine. And, you know, not perfectly fine, but it's, you know, one way of they think that's what's happening out there. But, you know, I think Corelogic are a pretty respectable company and they're not going to withhold data or show data incorrectly or anything like that. So take it for a grain of salt. Everyone's got their, you know, perceptions and perspectives on what happens with these companies and how they represent this data and how the media represents data. But, you know, any whiff of, you know, data being reported incorrectly will get smashed by the media, and then, you know, it'll all come undone. So, and I think Corelogic are a pretty reputable company and wouldn't do something like that. So yeah, I mean, with the lag data that we've got, that's all we're really seeing right now, but nothing major to report there. The Corelogic Daily Home Value Index showed a change of pace halfway through March. Data to early May shows the combined capital cities market as a cusp of the value declines. So yeah, there you go. And that's the decline in the market that we're sort of seeing now. This is a 28-day rolling daily home index combined. So we're seeing that fall quite significantly between March and May. And there you go. That's Corelogic presenting data as they should. You know, there's nothing to hide there. There's a fall in the market there. So anyone who's saying anything about Corelogic not reporting data correctly, and by all means, I'm not paid by Corelogic. I don't have any relationship with anyone at Corelogic. I'm just a fan of their reports and their platform. So don't hold me against anything that I'm trying to say here. I'm just giving you perspectives of things that you might hear out there, and having your own opinion and interpretation of what these graphs and companies actually demonstrate and show. So Sydney dwelling values increased 0.4% in April, so we're still seeing an increase in April. Dwelling values increased 3.2% in the quarter, so no massive impact on a quarterly growth. Sydney dwelling values are up 14% in the past year, 14% growth in a year of the pandemic, coming out of the 2017 to 2019 APRA sort of shut down or slow down. It's just crazy numbers. But yeah, as I said, if we don't see too much of an impact there, we'll probably see that momentum coming out of this as well. So Sydney dwelling values are negative 2.3% below their record high, which was in July 2017. Yeah, so as you can see there, there's still a little bit of growth left to go before those peaks of 2017. So yeah, gonna be interesting. You know, that might just shoot them off when we come out of this, and then projectile them up, but who knows? I'm not forecasting or an economist or anything like that, so don't hold me against it, but still a bit of growth there before we get to the peaks. Melbourne values have decreased by 0.3% in April. Very, very interesting. Dwelling values increased 1.4% in the quarter. So we're not seeing as strong a growth in Melbourne as we are in Sydney, which is very interesting because Melbourne generally tails Sydney with growth and all that sort of stuff. So yeah, interesting to see. Well, it's going to be interesting to see how this month is, March, because April was pretty much the highest or the lowest consumer confidence month. Like everyone was kind of like, oh, we're going to be locked down for 6 months. The market's going to crash. Everyone's going to foreclose on their properties and, basically going to have to sell them and all that sort of stuff. So very interesting results there. But what is good is Melbourne dwelling values are up 12.4% in the past year. So still some really good growth over that yearly period and nothing too concerning there. Melbourne dwellings are negative 3% from the record high, which was in March 2020. Yep, so we're pretty much at the peaks. We're just not, March 2020. So last month was the peak, or March was the peak. So not too much more growth to go there in terms of hitting peaks, but what's going to happen when we come out of this is going to be very interesting. Quarterly and annually change in dwelling values. Brisbane. So Brisbane dwelling values increased by 0.3% in April, so a little bit of growth there. Dwelling values increased 1.5% in the quarter. Brisbane dwelling values are up by 3.8% in the past year, so not a lot of growth in Brisbane, but still some positive growth, which is good to see. Brisbane dwelling values are currently at a record high, so they're at their record high right now. Super interesting. I can't believe property markets are at their record high. And when I say property markets, I'm talking these capital cities, but obviously there's thousands of submarkets within submarkets within submarkets within these categories. So don't mean a property market as a whole, but I still can't believe these states as a whole are, not even states, but submarkets, as part of a submarket, are still seeing record highs in the peak of a pandemic. Like that's phenomenal when you think about that as an asset class. I mean, that just proves the fundamentals. This property is the only asset class that we live in, and there's always going to be a demand for it. When these people from overseas talk about massive property falls, 30, 40, 50%, what they say is true. Is like, our economy's got 3 pillars, and China buys all our mining, which supports our economy. And if the mining, if China doesn't build anymore and they're not buying our materials, then one of the pillars is going to fall down in the economy, and then all the other pillars of the economy will fall. But I know we all say as Australians, Australia is different, but we have seen it in other countries like Japan and Ireland and all that sort of stuff. But yeah, I don't know. It concerns me that we're at a peak in the middle of a pandemic, but it's also quite reassuring as well, just to know that we haven't been hit like, the stock markets get hit 30, 40% in a couple of weeks. It's crazy. And I mean, there might be an ongoing effect of this over the next 6 to 12 months, but really with all those stimulus and stuff in place by the government, it's going to be hard to see. Adelaide up 0.4% in April. Good to see some little growth there. 8% in the 0.8% in the quarter, 1.5% in the past year, and they're currently at a record high too. So yep, a little bit of growth there. Nothing too dramatic or strong or fundamentally, but it's good to see that they've come out of that sort of downturn in the 19 there, coming out of 20 in this little peak here. Perth. We're up 0.2% in April, good to see. Increased by 1% in the quarter, so some good growth there. Perth dwelling values are down 2.7% in the past year, so they've really come out of this big downturn, which is really good to see. I've got a lot of friends that invest in Perth, so it's going to be awesome for them, and a good period. If they got in at sort of this bottom period here, they're actually not doing too bad, considering prices are still down. But yeah, some good strong growth there. Obviously, due to lack of data, we can't really see a massive impact there. I mean, at the monthly level, there's still 0.2% growth, so no downturn, still pretty flat. But yeah, it'd be interesting to see what happens. Perth dwelling values are now negative 20.5%. below the record high, which was in June 2014, and that's all due to the mining boom and all that sort of stuff as well. So it's hard to really correlate that sort of record high value to these mining towns that have just increased dramatically in the past and now are where they sit. Hobart dwelling values increased 0.1% in April, or decreased is negative 1% in April, negative 0.1% in April. Let me say that again. Hobart dwelling values have decreased negative 0.1% in April, just for clarification. Dwelling values increased 0.5% for the quarter. Hobart dwelling values are up by 5% in the past year, so not too bad. Some still strong growth in Hobart. And Hobart dwelling values are currently 0.3 below the record high, which was in February 2020. Okay, record high back in February 2020 is not that long ago, and they're sort of flatlined since then. So not really seeing too much impact here. Darwin has increased by 1.7% in April. Not bad, Darwin. Increased 2.3% in the quarter, but which is mainly driven by that April growth, which is phenomenal. They're down negative 2.7% in the past year, so they're still down. But Darwin values are negative 30.2% below the record high, which was in May 2014. Yeah, so overall, pretty interesting there. They seem to have come back up to that sort of standard level now, taking 2014 out of the picture, coming up to their peaks. So yeah, very interesting times. ACT, zero growth. They're up 1.4% for the quarter. ACT dwelling values are up by 4.3% for the past year. The ACT dwelling market is currently at a record high. So another market at a record high. It's ridiculous. Corelogics estimates that settled sales fell about 40% over the month of April, dragging down the annual change in sales. Yeah, so a significant decrease in change of sales there, or the number of sales there, I should say. Compared to that sort of decade average level, it's come down significantly. And, generally that would say, people aren't, there's low demand for housing, but there's still demand for housing out there. There's just not enough stock on the market, and because we're not doing open homes and ban on auctions and all that sort of stuff, it's just halted the market completely. I've talked to a lot of people who have refinanced in this time fine, that they've got access to credit because interest rates are so low. People have increased borrowing capacities now too, so there's a lot of money and stimulus flowing through into borrowers' pockets at the moment. And I think once consumer confidence comes back, we could be in for a hot ride, because there's people out there ready to go, ready to take the bullet, and some people are saying it's even too late. So yeah, who knows. Sale volumes are declining significantly as consumer confidence reaches its lowest level ever since the early 90s recession. Yeah, crazy. It's crazy to see that consumer confidence really come off. Like, look at that level. Is it at the lowest? Gosh, what's wrong with this thing? I'm just trying to level it out. Yeah, so it's pretty low. Oh, that's, lowest it's been since the 90s. My goodness. But as you can see, you see all these ups and downs, ups and downs, ups and downs, ups and downs. So, I think that light blue line is the 6-month rolling average. The light blue is monthly, and the yellow is Westpac Institute Index. So different metric there. But still showing the same thing. But yeah, that's phenomenal. That's just crazy. Back to the 90s, that consumer confidence in the recession. My goodness. So that's what I mean. People are scared, but also have access to money, and still got JobKeeper, JobSeeker. So yeah, it's a hard one to tell. I mean, if there's a wave 2 and we're in lockdown again, and the government isn't providing stimulus in the way that they are, that's when we probably will see a bit of a hit to their property market. But it's just stagnant. It's just on hold. There's people still buying, there's people still selling, but nothing near the numbers that we're seeing beforehand. And it looks like we're going to come out of this okay if we keep to our little AUNZ bubble. And looks like it's just going to be stagnant until they start to take off again. COVID-19 has interrupted the recovery in already weak rental market. Annual growth in rents almost halved in April to 0.8%. Yeah, the rental market is what's getting hit so hard at the moment, because people are going back home, living with their parents, finding a way to do it cheaper. Airbnb listings are coming onto the market. All those short-term stays are coming back onto the market. There's just been a huge influx of properties coming onto the market, and then on top of that, you've got people asking for rent reductions and all that sort of stuff, which obviously is what's reflected here. I still think this doesn't really represent how bad it is out there. I've got plenty of property manager mates, and they're just telling me the stories like you wouldn't believe. So I think we're starting to see some good reforms and stuff come through for that as well. So some more standardization. I mean, when the pandemic first hit, people were like, "Oh, I'm not going to pay my rent. You can't kick me out for 6 months, so I'm not just going to pay it. That's it." But now I think we're seeing some good sort of stuff come through. So hopefully that stabilizes that a little bit, and we see the rental market normalize a little bit. But yeah, there's just so much going on in that space at the moment. Nationally, gross rental yields fell a further 2 basis points over April to 3.72%. As declines in rent outpace value declines, yields are likely to compress even further. So yeah, essentially the rental yield is the rental income versus the price of the property. And so as prices of property aren't falling as dramatically as rentals prices are, as we were just discussing, that rental yield comes down because the value of the rental income is coming down quicker than the value of the property is. So rental yields are coming down faster. So if the prices of property were to come down quicker than rental yields were coming down, so it's like this, then the rental yield would be increasing because the prices of the rental income relative to the prices of property is growing at a different pace. So it would increase, but yeah, as they're saying here, it would compress further. Already, some rental markets have seen a significant uplift in rental listings off the back of falling demand and increased supply. Yep, so big supply and demand there. Melbourne being the biggest leader there, change in total rental listings. Yeah, that's crazy. Between the 22nd of March and the 26th of April, so a bit longer than a month span there. But yeah, Melbourne inner is getting hit the hardest. Sydney and inner, South, Sydney Eastern, and Adelaide, Central and Hills. That's very interesting. Gold Coast, Sydney Sutherland, inner South. Yeah, so they sort of really inner CBD areas are getting obviously hit the hardest here. Days on market was lower over the year to April 2020, although this may steady as housing demands ease. Yeah, so essentially how many days a listing will sit on the market has decreased, and we're probably seeing that due to the surcharge that we saw pre-COVID-19. But yeah, as they're saying here, it might steady out and sort of increase a little bit over that time as we've well, in saying that though, you know, supply is short, so there's not a lot of stock on market. So if someone's buying, they're probably buying pretty quickly, taking action. So yeah, very interesting. By April, all markets saw an annual decline in vendor discounting, but as the market turns, vendor discounts are likely to become larger. Yeah, so vendor discounting is pretty much how much a vendor is willing to discount their property by. And as we're seeing a bit of an increase here because the market was increasing significantly, you know, are likely to become larger, they say. So yeah, we'll start to see this come down as people are giving bigger and bigger discounts. But yeah, interesting they said that. By April, all markets saw an annual decline in vendor discounting, but as the market turns, vendor discounts are likely okay as the market turns, which I don't know, are they suggesting that it has turned or it hasn't turned? I mean, obviously we're starting to see that daily change come through, but we're not seeing anything on that sort of quarterly or yearly yet. So yeah, be very interesting. I think we're going to see some stagnant data through, you know, the 6 months following sort of February, and then hopefully there's an uptick. But yeah, I don't know. I just can't see people foreclosing on properties with all the stimulus that's available right now, mortgage holidays and all that sort of stuff. I just can't see a significant turn in the market. I can see obviously a bit of a turn, bit of a slowdown, but not a sharp up or down just yet. At the 28 days ending 3rd of May, new listings have fallen to lower levels than the lead up to last Christmas. My goodness, that's huge. So obviously we have a slowdown sort of Christmas period at the start and end of each year. Then this is about sort of Easter, Anzac time, and it slows down into the winter period. And then as we come into sort of September and it gets hot again, that's when we see listings start to come back on the market and increase quite significantly because, you know, the flowers look great, the lawn looks great, everyone's outside and happy and cheerful, and more listings come on the market because they think their property looks better and a better time to sell, and generally they do. But yeah, this because even this last month was quite low, but it's just continued to come down. So the number of listings are just pretty much nosedived. It'd be interesting to see this in comparison to, like, I don't know if we'd have the numbers, but you know, the GFC and you know, that early 90s period. of the depression. It'd be interesting to compare the number of listings on a yearly basis from here, but yeah, that's a significant decline, and that's why there's such a supply shortage on the market right now. Total listings are also at the lowest level in years. This may explain why values have shown relative stability. Yeah, so low levels of stock, still some strong demand for specific properties with specific people. Obviously not as much demand as there was beforehand, but still demand, but lots of stock's been ripped off the market too. So supply and demand, I've always talked about it. It's in heaps of my videos. If you're not sure what it is, go check it out on YouTube. But yeah, essentially supply and demand are sort of evening out here, because supply is coming down as demand's coming down, but demand's not coming down significantly, but supply is. So that's why they're saying that sort of sustainability or stability of the prices or the listings are or the values are relative, or that didn't make sense. While the values are staying relative due to supply and demand, and we should see a stable market going forward until stimulus starts to come through. Greater capital city and rest of state regions have seen an average annual decline in total listings of negative 25.3%. Wow. An average annual decline in total listings. Greater capital city and the rest of state. Yeah, that's phenomenal. So negative 25% of listings. That's huge. And you thought, look at these markets. They're the big drivers. Equivalent period last year, new listings, total listings. Yeah, okay. Yeah, so total listings down around negative 25%. That's huge. It's a quarter of the market's come off. Quarter of the market of supply has dried up. Very interesting. Next page. Clearance rates have been skewed lower by a surge in withdrawal of auctions. I really don't like to show this graph because it doesn't mean anything right now. There's a ban on auction, so we can't use it, we can't look at it, we can't relay it, we can't relate it, we can't look at it in any shape, format, because there's a ban on auctions. Properties are getting sold in different ways, online auctions, but this still should be reported quite here, but private treaty and sold prior to auction and all that sort of stuff. So nothing really to talk about here. Can't use that data. It's going to be interesting to relate it later on, but yeah, there's nothing really. The clearance rate can't be reported correctly until auctions are back to normal. However, recent data shows fewer auctions are being scheduled. This has lowered the withdrawal rate and lifted the clearance rate from recent lows. Yeah, so essentially, as I've talked about in previous videos, auctions are completely withdrawn when there was a ban of auction. Nothing really too significant there. It was a policy, so it's not like thousands of people have pulled off the market. We literally couldn't have auctions, so that's why that happened. And then auctions sold prior. So what they're saying there is essentially there's less auctions being scheduled because we can't have auctions, and so those sold prior numbers are not showing as highly because we don't have all these listings that were once on the market and then we're going to auction, but now we can't auction, so we need to sell them prior. So we're just sort of seeing that stagnant market flow through. Trend data indicates that dwelling approvals were starting to rise, following declines from the end of 2017. Monthly number of dwellings approved for construction. Yeah, so construction dwellings have come down. They're relatively stagnant there, but obviously down from the peaks of sort of 2018 to 2017 there. But yeah, significantly down. I mean, it's only about 2,000 per month, which that's 20%. It's pretty big actually. It's a pretty big drop from the peaks. So yeah, interesting to note there, and that'll be an interesting one. And interestingly enough, units have picked up. Units have picked up and compared to houses quite significantly. So it'll be interesting to see if this unit number starts to come down a little bit, but I don't know. It seems to be doing better, and I don't know if that's because people but units are at a lower price point and are more have more demand because of that lower price point, and that's why we're seeing more approvals of them. But yeah, very interesting. In the lead up to COVID-19, aspects of lending conditions eased slightly, but the financial system remains strong. Yeah, so interest rates are the lowest they've ever been, and people have got access to finance. I haven't really heard a whole lot of people having issues with finance and all that sort of stuff. I mean, I've heard of particular clauses coming out on contracts right now. You know, you must have maintained job before settlement date or on the date of settlement, and you know, little things like that. But I think they were kind of an irrational reaction from the banks, ensuring themselves that they're going to be, you know, okay at that point in time. I'm not really hearing. I mean, I've just refinanced 2 mortgages. I've gone for another home loan as well, and that's been approved. So, you know, I'm not having any financial difficulty though. So there might be other people in certain circumstances that are having hardships, but I'm in contact with plenty of mortgage brokers and aren't really hearing or seeing a lot. So yeah, interesting times there. But what are we seeing here? Interest rates for the new loans funded. Yeah, so significantly lower interest rates there. The lowest 3.4%. It's lower since March. Same for the weighted average assessment raised used for serviceability has come down significantly, and that's why I'm saying, you know, people have more access to money. It used to be assessed at 7.3%, now we're getting assessed at 6.3%, so there's 1% right there in additional serviceability that gets calculated. So interesting, not on top of the total amount, but that serviceability rate or assessment rate that we're getting done out is down 1%. So portion of new loans funded to interest-only terms, so we're down to 17% from 20% in June. And proportion of new loans funded with less than 80% LVR, so 38%. So less and less loans are starting to come down on a lower LVR, which means, you know, people are being more safe and secure. And yeah, see, I still don't like the way this represents this graph, because it looks like that number has dropped significantly or increases significantly. But you know, it's not a zero indexed graph there, so it's not relative. These jumps look much higher than they do compared to the zero number. Monthly value of new finance commitments, total in billions of dollars. So, yep, still seeing that strong. Is that their owner-occupiers? Yeah, so still seeing some strong growth there from owner-occupiers, starting to dip down a little bit, obviously due to this period. And I think, you know, as we're not seeing, you know, when you think about financial commitments, that's happening when properties are always consistently transacting. And as we're seeing less and less properties transacting, that number is going to come down naturally anyway. It's not that the value of the properties have come down, it's just that we're transacting less. Portion of new lending for investment housing excluding refinance. Portion of new lending investment housing excluding refinance. Yeah, so that's nosedive completely. I'm presuming that dot point is the decade average, but yeah, huge drops there. New home loan lending fell 1.7% in February 2020. The relatively low portion of investor participation provides some insulation for the housing firm retreat of investors as a result of current downswing. Yeah, very interesting. Come on. Why do you not want to go to the next page? Before the onset of COVID-19, first home buyer participation as a proportion of owner-occupiers was at its highest since January 2012. First home buyers as a proportion of home owner-occupier finance commitments. Yeah, so still seeing first home buyers being a big portion of the market there, looking at sort of 30s, 40s, even down to sort of the 20s there though in New South Wales. Well, what's that bottom one? It looks like South Australia is the sort of below 20s. Oh no, it's still quite high. It's 24, 20, 23 in South Australia there. And then obviously the peak is WA up here at sort of, I don't know, 38, something like that. But yeah, big segment of the market. Oh. The numbers are on the right-hand side here. So yeah, yeah, Northern Territories, 41%. WA's at 37%. Victoria's at 31%, New South Wales at 27%. So it's still a big segment of the market. It's more than a quarter, so pretty interesting. Over February, investor participation continued to decline in most states and territories. Investors as a proportion of the total value of lending excluding refinance. So yeah, as you can see, that's broken down on sort of a state-based level there, and the investors are continuing to decline, which is pretty interesting. Investors aren't buying as much as they were, but yeah, it'll be interesting to see these numbers in sort of 6 to 12 to 18 months, and you know, if there is a sort of a kick up after the whole COVID-19 thing, you know, there's more accessibility to lending, you know, all that sort of buffers and safety minimum standards and all that sort of stuff has sort of been ripped out, and APRA's been pretty, not loose, but looser than they were in 2017, and access to borrowing is a little bit easier than it was. So going to be interesting to see how this looks moving forward. Average owner-occupier mortgage rates came down to 25 basis points over the month of March, while average investor rates fell 26 basis points. Yep, so still seeing the cash rate there at the lowest it's ever been at 0.25%. Average mortgage. So still seeing 3-year fixed rate for an investor at 3.12%. That's ridiculous. 3-year fixed for an owner-occupier is 2.75. Yeah, so if you're an owner-occupier and you're not seeing, a 2 in front of your number, I'd be looking to refinance. And same with investors. If you're not seeing a 3, and if you're paying more than 3.5, I would be looking to refinance, or calling your bank, or talking to your mortgage broker, and just seeing what you can do out there at the moment. It's crazy times. And that's it, guys. Thanks again for tuning in. It's always a pleasure talking to you. Obviously, no financial advice today. Seek your own advice. I don't know your personal circumstances. Everything in this video is just my opinion and my interpretation on what the graph and the data are showing us. Sometimes I ramble and say too much than I should, and don't actually, it's just my thought process, really. So don't take anything today as financial advice. But yeah, I hope you guys are all staying safe and looking after yourselves and your family, and hopefully we're back to work sometime soon. Hopefully we can start to see everyone sometime soon, catch up on that Mother's Day that we've missed out on, and see the family and get back into things. I think this time period has really shown what is valuable in life and important and what matters, and that's family for me. So I'm sure you guys are going through the same process, and even some things have been shaken up, like you think your job's so secure for so long, and then all of a sudden it gets ripped out from you. So I think it's going to be a new world moving forward, but let's just take our lessons, take our values, take our teachings, and use them moving forward into the future. So anyway, guys, stay safe. Hopefully we'll see you out and about in the streets sometime soon. All right, talk to you soon. Bye.